Good. So I want to move on to the next question for our panel. While the U.S. economy has been strong despite low inflation, there's a real threat that interest rates will rise in the U.S. By the end of the year, and Canada may or may not follow suit. So the question is, what are the implications of rising interest rates, and how would they impact your investment and asset management strategies? And will this have a negative impact on your returns? So Don, let me start with you. Can you tell our audience how interest rates directly impact GWL?
Sure. So just in terms of how we manage our portfolios, most of our clients are very conservatively positioned from a debt standpoint. So the typical leverage would be 20 to 25%. And consequently, we're probably more interested in what the fundamentals are that are driving interest rates as it relates to how that helps to shape our portfolio action. Real estate's a good hedge against inflation. And typically what happens in a rising interest rate environment is that there's a business expansion which also occurs with rising rents. So revenues go up, and typically real estate returns have been pretty strong during periods of rising interest rates.
Thank you, Don. Andrew, same question. Grosvenor is very active in development of real estate in major markets in Canada and the U.S. How do interest rates impact your business?
Well, on the development side, it will make housing more expensive. So prices may fall. It affects us directly in the way we're a private company, but we have if you like, a synthetic weighted cost of capital. It affects how much we can pay for properties. We have a risk-free rate that we take for granted and which is fed into our calculations.
Is your risk-free rate bonds?
It's risk-free bonds, yeah.
Yeah, okay. Yeah. That's worthwhile talking about for a second. Yeah. So much as, the benchmark that we probably all use typically is 10-year Canadian bonds if we're investing in Canada. And, spreads are pretty wide right now by historic standards. So, cap rates exceed the 10-year bond rate by about 400 basis points on average across the country, melding all asset classes. Those aren't the spreads that you can get in Vancouver, but that's the average. So I think the point is, if interest rates rise here to a degree, there's still room for values to hold.
And just before I move on to John, would you both agree that the drop in interest rates that we experienced the last 5 or 6 years has gone way beyond anything you ever thought would happen? I mean, we're at record level lows now, so when it goes back the other way, it's going to push cap rates back up. I mean, that's what probably should happen.
Yeah, and we've had this concern for years, and the way around that is when you buy an asset is you focus on the NOI, the net operating income, and what you can do with it.
If you can grow it.
If you can grow it, yeah.
Mm-hmm.
Yeah.
So John, Venterra is primarily acquiring multifamily rental apartment complexes in the south and southeast in the U.S. Have you benefited from lower interest rates during the last 7 or 8 years? And how will you make that adjustment if they do go up in the U.S., which sounds like is probably going to happen?
Yeah, well, over the long term, I tend to disagree with that last point, actually. I know it's not a popular view right now. As it relates to interest rates, I think there's 2 issues. One is, I think, the most important issue for our age group, the older people. And there's another one that I think is really important for your kids when they start thinking about investing. Interest rates, in our opinion, we've been saying this for a long time. I know this sounds like a bit of a stupid projection given what's happened in the bond markets lately. They're going to be lower for longer than people think. They're going to be higher under Trump than Clinton because of spending, but I think they're still surprised to the downside. Interest rates over the long term, in our belief, are a derivative of demographics more than anything else. And good real estate needs inflation. And why is that? Well, good real estate investing. Because the mathematics are you can inflate 100% of your revenues. Depends how highly levered you are, but if you're on a fixed interest rate, maybe a third of your costs are constant. So you have this positive drop through, and that's why real estate's a long game. That's how you make money in it. So I believe that successful real estate investing going forward is all about a hunt for where inflation is going to be, because inflation is something we've taken for granted, and I don't think it's going to be as widespread as people of our generation are going to expect. So if I look at the single most important thing, in our opinion, that's happened in the last couple of decades, it's this. There's a point. Think about it. The only major industrial country in the world that's contemplating raising interest rates is the States. And why is that? It's because they're the only major country that has a growing working age population. And so we've had an event in the last 35 years that the world has never seen the likes of and will never see the likes of again. And that is that China's working age population, those between 18 and 65 years of age approximately, increased by 380 million people in that 35 years. That's more than the accumulated population of the entire United States since the first pilgrims stepped on Plymouth Rock. And so why is working age population so important? Well, they're really important for a couple of reasons. First of all, there's systems. There's a welfare system. There's a retirement system. There's healthcare systems that you need a growing working age population to keep those things financially solvent. And then just quite frankly, working age people can spend more. They add a vibrancy to the economy because they have jobs. And they have to spend more because they're creating households and filling them up with kids and filling it with furniture, et cetera. So that 380 million people that the working age population expanded in China in the last 35 years, and this is what I really think is causing conniption fits in the marketplace, and this is why interest rates are not going to be as high as people anticipate, has done this in 2014, 2015. It started to contract. So over the next 35 years, and we know this with certainty, because demographics are one of the few things that's really important that you can predict. It takes 20 years to have a 20-year-old. You know what the demographics are going to be. 212 million people it's going to contract by that size, the working age population in China. That's 23% of their working age base. Japan's going down by 27%. The EU is going down by 11%. The US, over that next 35 years, its working age population is going to increase by 16%. Texas is going to increase by 40%. We haven't seen this kind of demographic since after the Second World War in the 60s. So it's about a hunt for inflation, and where do you think inflation is going to happen? The States is going to, we know this directionally, is going to go from 320 million people to 440 million in the next 35 years. There's nowhere else like that. The challenge for us is to find those places. And the southern states are not the only places to find growing working age population, but it's one of those, the one that we've identified. But it's not the only game in town. The challenge for your kids and investing is going to be dealing with outright population decline. There's 25 countries in the world right now that are experiencing that. It takes 2.1 children per woman to have a stable population. If you look at Canada's fertility rate, it's not 2.1, it's 1.6. Texas is 2.1. Canada's average age is 39, Texas is 34. So that's what we look at when we look at trying to determine what's going to happen with interest rates and where we're going to invest. And there are definitely spots in Canada to invest. I'm not saying that. I mean, Vancouver and Toronto are great, but that's why I think interest rates are important. Inflation is really important, and we invest on where we think there's going to be above average inflation.
Sounds like you're still pretty bullish on the U.S.
I am.